Welcome back. In the previous video, we covered the basics of IAS 16, that is property, plant and equipment, as to how they are recognized, how they are measured initially and subsequently, and finally how they are derecognized or disposed. If you haven't watched the IAS 16 basics video yet, please watch that first and then come back. It will help you understand today's topic much better. Today, we are continuing exactly from where we left. Now that you know how the assets came into the books, let's learn how they are depreciated. In this video, I'll explain the three main depreciation methods under IAS 16 with simple examples. As per IFRS accounting standards, depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. So what do you mean by depreciable amount and what do you mean by useful life? Depreciable amount is the cost of the asset or other amount substituted for cost less its residual value, the value that the asset can be sold after its useful life. So depreciable amount equals to cost minus residual value. What is useful life? Useful life, it is the period over which an asset is expected to be available for use by an entity, or it is the number of production or similar units expected to be obtained from the asset by the entity. Using these two items, we can calculate depreciation by three methods. The first one is the straight line method, diminishing balance method, and finally it is the units of production method. Let's see one by one in detail. What is straight line method? In straight line method, the depreciation charge remains constant over the useful life unless the residual value changes. As we read earlier, depreciable amount is nothing but cost minus residual value. So as long as the residual value remains same, the depreciation amount remains constant. So the formula is depreciation equals to depreciable amount divided by useful life. Depreciable amount is cost minus residual value divided by the useful life. Let's consider an example. If you have purchased a machine for say $50,000, the residual value is $5,000 and the useful life is 5 years. Now all these are by judgments, management's judgment as to how long that asset can be used, etc. So depreciation is nothing but 50,000 minus 5,000 divided by 5, which is $9,000 annually. So for 5 years, when I take a table and try to jot down the depreciation charge, if you can see here, it remains constant as 9,000. Accumulated depreciation is nothing but the addition of depreciation on a yearly basis. So the first year accumulated depreciation remains 9,000. The second year, when the next 9,000 is being added, it would become 18,000. 9,000 plus 9,000. So accumulated depreciation is accumulating your depreciation over a period of time. What is net book value? Net book value is basically cost minus accumulated depreciation. So I have cost as 50,000, depreciation as 9,000. My net book value for the first year would be 41,000. And in the next year, I would be considering the accumulated depreciation here. So cost 50,000 minus 18,000 would be 32,000. So if you see at the end of year 5, I get the residual value which remains in the books until the asset is disposed or sold, because I expect that the residual value is the amount that I will receive when I'm going to sell the asset or when I'm going to dispose the asset. Hence, that value remains in the books as long as the asset is in the books. Now, if there is any change for the residual value, for example, after 5 years, the machine has become obsolete and the residual value becomes 0, then I will have to write off this 5,000 as well and maintain it at 0 or dispose the asset. So residual value is also a judgment or an estimate made by the entity as to how much they will receive by selling that asset. The useful life, the residual value, the depreciation method. All these three have to be reviewed on a yearly basis by the management. So when I take a graph of what has happened in this example, as you can see, the graph remains constant at 9,000. So the depreciation charge remains constant. This is one of the main advantages of straight line method. Once a depreciation charge is calculated, it remains constant throughout the period of the asset. The second method is the diminishing balance method. Under diminishing balance method, depreciation charge decreases. It decreases over the useful life of the asset. This is also known as reducing balance method because the charge keeps reducing or diminishing or decreases as the years pass on. So the formula for calculating the depreciation would be net book value into rate of depreciation. What is net book value? As seen above, it is the cost of the asset minus accumulated depreciation. And rate of depreciation would be nothing but 100% divided by the useful life of the asset. Let's see an example. So I have an asset which is costing 50,000. The useful life is 5 years. Depreciation for the asset as per the diminishing balance method would be net book value into rate percentage. Now if I have to calculate the net book value for the first year is always considered using the cost because my accumulated depreciation would basically become zero. There is no depreciation charged. Hence, it would be nothing but the cost into the rate percentage. Now, what is my rate percentage here? It is 100% divided by 5 years. So, basically, it is 20%. Hence, the depreciation for the first year would be 50,000 into 20%, that is 10,000. Now when I have to calculate the depreciation for the second year, it would be first I'll have to calculate the net book value. What is my net book value? 40,000. Now what is my rate of depreciation? 20%. So for the second year, it would be 40,000 into 20%. So basically 40,000, how did I get? It is nothing but 50,000, which is the cost, minus the depreciation charge for the first year would give me 40,000. That multiplied by 20% would give me 8,000. So this is the depreciation charge for the second year. As you can see, the depreciation charge is decreasing as the years go on. So in this method, the depreciation charge is not constant and it keeps decreasing. Now another important thing to note is here, though I said the useful life of the asset is 5 years, if you see at the end of 5 years, I still have a net book value of 16,384 and this keeps continuing until infinity. Basically until whatever time that asset is being used, the depreciation charge keeps continuing. This is depreciation charge as per the diminishing balance method. So in the graph, there is a constant decrease in the value of depreciation. The third and the last method that we'll see in this video is the units of production method. As per this method, depreciation is charged based on the expected use or output. So basically, if you're buying a machine for your factory, you would know how much units that machine would produce. If you are aware of that, then this would be the right method to choose. In this method, the formula remains almost similar to straight line method, but the main variation in the formula for depreciation charge is the estimated units, total estimated units in place of useful life. So the depreciation per unit would be depreciable amount divided by the total estimated units, meaning to say how much units of output that machine could produce. So if I have to calculate the depreciation for the year, it would be depreciable amount, that is cost minus the residual value divided by the total estimated units into how much units is produced during the year. So let's consider an example. Assume I have purchased a machine for 50,000. The residual value remains as 5,000. The total estimated units that can be produced out of that machine is say 50,000 units. In the current year, I have produced 20,000 units from that machine. the depreciation per unit would be 50,000 minus 5,000 divided by the total estimated units, 50,000. So it is basically $0.9 per unit. This remains constant unless and until there is a change in the residual value. Now what would be the depreciation charge for the year? It would be 0.9 into how many of our units have been produced during the year. So in the year 1, if I have produced 20,000 units, then it would be 0.9 into 20,000, which is nothing but $18,000. So below is the table where we can see based on the units produced, the depreciation charge varies. If you see in the second year, 10,000 units have been produced. So that multiplied by 0.9 has given me 9,000 as the depreciation charge. In the third year, the number of units produced have increased. It has become 15,000. So my depreciation charge has also gone up and become 13,500. So in this method, there is no constant increasing or decreasing. It all depends upon the number of units that are being produced by that particular asset. And based on that, the depreciation is charged in the income statement. So all the depreciation expenses have to be charged in the profit and loss account. So to conclude this video, I would like to revise on all the three methods. How would be the pattern where each of the method could be used. If it is a straight line method, the depreciation charge would remain constant and it is best suited for buildings, furnitures, vehicles, etc. If you are using diminishing balance method, the depreciation charge would reduce from highest on the first year to the lowest on the last year. It is best for machines. And finally, units of production method, it completely depends upon the usage. So it can be either increases or decreases depending on how much units are produced, and it is the best suitable model for manufacturing machines. I hope you would have liked this video. If you have any questions, please do mention in the comments below. I would be happy to help you to sort them out. For more such video, please do like, share and subscribe. Thank you.